Swiss National Bank is one of the largest holders of Apple stock. The Swiss National Bank. It's amazing how much money the banks. And this week, as we're talking, the ECB is talking about buying stock. So they're propping the markets up. This is incredibly dangerous. What's happening? I haven't been as nervous as I am right now ever. This could all break down really quickly.
Our back up the truck moment is here. Just $10,000 into Keith Neumeyer's last two deals could have been turned into $1.8 million for investors. Now he's going all in with a gold acquisition company, a precious metal mineral bank. We consider this a gold portfolio must. Learn more at futuremoneytrends.com/fortune.
Hello everyone and welcome into crushthestreet.com. I got a returning guest today and someone who I think it's very timely to talk to this person. His name is Durrett and he's with goldsilverdata.com. He's also the author of an excellent book, How to Invest in Gold and Silver, a complete guide. And it's a great book, by the way. I had the chance to read it. And you know what? I think we're probably going to end up talking about some things in that book. But first of all, Don, thanks for joining me today.
Thanks for having me back, Ken.
Don, in prior interviews, you pointed out that 1310 is a significant point for gold support here. And I want to bring that up because I noticed in just this last correction that we saw here in August that 1310 was right about where gold bottomed out and then went higher from there. So let's get your thoughts on this.
Well, that's the higher high for year over year. That's why it was such a significant support level. In other words, 1308 was the high from the previous year. So once it got above that, it created fairly solid support. Since we've crossed 1308, we haven't actually traded a little under it, but we didn't close under it. I think we got down to like 1305 on a trading basis, but then it immediately jumped back above 1310. So, yeah, 1308, it's a very important level. The next level below that is 1290, which is the 200-week moving average. So I know technicals, a lot of people are looking at 1290, and then big one below that is about 1225, which is a 200-day moving average. So those are our three support levels. I'm fairly confident that the 200-day is going to hold, and it'd be really nice if 1308 holds, which is still very possible. But we went up against 1360, 1365, and we haven't been able to break through that. But today we made a good move. We went up $20 in gold, but we're still below that 1360 level. We'll see what we do this week. We'll see what we do this month. But the most important number for me is 1400. We're looking at all these support levels. We're trying to break through them. We're trying to stay above them. We have to get through 1400. 1400 is actually when I get excited. So right now I'm kind of in a wait, mood, wait. Make sure 1225 holds. Once we get over 1400, that's when I get excited. If we can close over 1450 on a weekly basis, it's pretty much all over. Once we do that, we can pretty much sit back and watch as the trend goes all the way to a new high, which would be above 1935.
You know what? And that's actually what I wanted to get to next and talk about what we are seeing here when we do get to that 1450. So explain to people why that is a significant number and why you feel that there's just going to be this massive gap up between 1450 and gold's all-time high.
It's a couple of factors. The biggest one is the technical charts. So gold basically made a really big, fast move from 1935 all the way down to 1450. And since it moved down so quickly, we have this gap. There just isn't a lot of support once you get over 1450. And also, once you get over 1400, the public is going to start taking notice of gold. Already you're starting to see banks starting to buy gold stocks. So what the banks, first you have the retail, then you have the banks, then you have the consumers jump in. So they're going to start jumping in at about 1400. And once we get over 1450, the technicals are really going to be really favorable for gold. So what you're going to have is a trend. So it's going to be really difficult for anybody to slow that trend down. That's why I say once we get over 1450, the trend's going to be so strong, and there's not going to be any technical resistance to stop it. You're just going to trend higher and higher and higher. And that's where the economy comes into play. And that's the other reason why I'm fairly comfortable. I don't think we go over 1450 unless the economy weakens. And if the economy weakens, then it's just, here we go. We're going to just trend higher.
Don, I want to ask you about September here. Going back for decades now, September has been the best performing month for gold on average. And I want to get your thoughts as to why this is and, how it's playing out with your analysis.
That's true. And for the listeners out there, the reason why it's the best month is because of India. It's basically what some people call the love trade. That's when the marriage season is in full bloom, and that's when you have a lot of weddings and a lot of gold demand, and it just seems to always push gold up in September. But this year, it's a little different, I think. This is somewhat of a dangerous month. It's because it could go either way. I mean, we could go down to back to 1225, that 200-day moving average this month. We don't know if we're trying to break through 1365. If we don't break through 1365, we could break down. Silver just keeps teasing us. Today, silver jumped back over 20. It's been over 20 solidly for, several trading days since August. And silver's teasing us because silver will not lead. Gold's going to lead. So if gold can't get over 1365, silver will break down. So September, it could be a fantastic month. Again, we can get over 1400 this month. We'll see what happens. I don't know. I'm somewhat bullish because of the economic numbers. We'll talk about those. They all tend to be leaning towards a weaker economy, and so the weaker economy could allow gold to break out here. It's very possible for gold to break out here in September. It could happen, but it's not a fait accompli at this time.
Well, the underlying economy is definitely crumbling, and we can see that with the way the Fed can't seem to make a decision on what to do with interest rates. But talking about the season, the fall season, September with gold and, September, October tends to be a time where stocks tend to have their problems going back to 08, 1987, 1929, and even Black Wednesday when Soros raided the British pound. And this all tends to happen, these big moves in the fall here. So let's talk about the economy. And it certainly seems like the economic numbers, the political landscape, it's all coming to convergence here. And it wouldn't surprise me if we do see another big crash going into the fall of 2016.
You're right. This is actually a pretty good timing for gold to break out, because if the economy does break down here in the fall, we're probably going to see this breakout that I say it's possible, the 1400, 1450 level. Very possible because of this. So I've written down some of these economic numbers. I can go over them. So I've been watching them all closely because I actually haven't called the bull market yet. And I keep saying until we get to 1450, this thing could all break down. However, this is the first time that I've spoken where I'm this confident because of the economic numbers. I've been watching them. For example, the PMI numbers, which is your manufacturing index, has pretty much been flat since the end of 2015. In August, it was at 49, which is negative. So, and new orders for new factory orders have actually been trending down for 21 consecutive months. Consumer spending appears to be somewhat of a bright spot, growing about 3% annual growth. But when you take out Obamacare, when you take out all the healthcare spending, consumer sales is actually flat. Retail sales for July had zero growth. It was flat. If you look at shipping, the Baltic Dry Index, it's kind of fallen off a cliff since 2008. It was at 11,000, and now it's down to 700. Can't seem to get going. Everybody knows that global trade is very, very quiet. Almost it's almost dead. Some people would say. I mean, we had South Korea, one of their largest shippers, went bankrupt last month. Hanjin, sixth largest shipper in the world. Your train traffic has been for shipments, for those big container shipments, is off considerably off 2015. Your heavy truck sales, your rig sales, are down. Housing looks like a bit of a bright spot because prices are up. The prices are up because interest rates are down. We're still way off of our historical norms. So housing, some people think it's doing okay, but it's looking like a possible bubble actually. Autos, this is really significant, is autos. So August has been the first really bad month for the autos in years, really. You had GM, Ford, and Toyota all down 5% or more. You had the Ford CEO come out and say that sales have reached a plateau and that he expects sales to be down this year and next year off of our 2015 highs. So, and then if you look at jobs, so five out of the last 8 months for this year have been under 200,000. And then last Friday, the non-farm payrolls are 151. So jobs are definitely not strong. And then of those 151, the majority of them are low-paying jobs. So if you look at all the economic numbers, you don't see a lot of strength, and you see the potential for what you were talking about. You see the potential for the stock market to break down. And I'd like to talk about this S&P 500 chart sometime during this conversation.
So yeah, Don, I don't know how people can deny those facts, especially some of these mainstream pundits who tend to ignore those very things that you were pointing out and just act like things are okay and that the economy is not as fragile as it really is. But let's go into the charts, the S&P 500, and discuss this. Go ahead, sir.
Yeah, so I would recommend that people pull up the S&P 500 chart and look at the history of it, going all the way back to say 1990, even back to 1980, and you will see these three basically big bull markets. One of them was in the late 90s where you had the tech bubble, and it peaked out in the year 2000 at 1,500, and then it dropped down to 825, which was a couple years later, which was a 45% correction. And then right after 9/11, basically the Fed kind of juiced the markets. We had another big bull market run from 2002 all the way up to 2007. Went from 1550, and then it crashed down to 680, which is a 55% drop. Then right after the last recession or the big crash we had in 2008, starting out in early 2009, the S&P's done nothing but go straight up. So it went from that bottom right around 680, and it's at an all-time high at 2186. So it's pretty much had this incredible run. So if you look at the historical chart, if it falls 45-50%, you're looking at a really, really potential big drop. And the chart is setting up for a very, very big drop. It's possible. I don't know if it's going to happen or not. I mean, we could get inflation, and it could go higher. But even if we have inflation, you don't get the value. Also, with the S&P, if you look at the price earnings, the PE rate's now about 17, which is that's up there in a very high valuation point. I don't know if it can hold much longer, the 17 level. It's really a healthy market is more like 10.
Yeah, so going over the S&P 500, I don't know how people can deny, again, why the S&P 500, the overall stock market, is just completely overvalued. And you have this situation here where, you go back 30 years, it correlates completely with U.S. debt. And we're at a situation where, the Fed, the government really can't print and borrow anymore. I mean, they can, but the effectiveness is losing its punch. And, we're getting to that breaking point, and I certainly can see why we are due for a massive correction. I mean, you're talking about a 45-50% correction on the S&P 500. That's going down close to 10,000 on the S&P. Is that what you're talking about?
Yeah, 1,000.
1,000.
Yeah. That's what the charts basically show us. I mean, if it follows the last two ones. Now, I can tell you why it's overvalued. The reason why it's overvalued is two reasons. First reasons is the central banks basically manipulating interest rates so low that it's basically the only game in town. So people are putting their money in stock markets. Now, last year the stock market was up substantially. So people keep their money, they can let it ride. This year it's up about 5-6%. So people are saying, oh, it's not doing that bad. So people are basically, even though it's really frothy, they're continuing to buy it because of these low interest rates. You can't keep your money in a savings account. You can't put it in, it's earning zero. Money market fund. It's really tough to find, investment. That's point number one. Point number two, which is probably more significant than low interest rates, is that central banks have been buying stocks. This is unprecedented. Japan, the Japanese central bank, they're the highest stockholder in 450 companies in Japan. This is totally unprecedented stuff. Yeah. So the Swiss National Bank is one of the largest holders of Apple stock. The Swiss National Bank. It's amazing how much money the banks. And this week, as we're talking, the ECB is talking about buying stock. So they're propping the markets up. This is incredibly dangerous. What's happening? I haven't been as nervous as I am right now, ever.
Don, you mentioned
this could all break down really quickly.
Don, you mentioned something very interesting about the stock market being the only game in town. And interestingly enough, that's kind of the globalist agenda, is to globalize one world, one banking system, this whole aspect towards this interconnected global economy. And would that be why? So there is only one game in town and everyone has to play by that rule, and there's just that control over the system?
No, I look at a little different angle. I see it as the central banks only have so many tools at their disposal. And the biggest tool really they have is interest rates. So it was just kind of by, happenstance that the stock markets kind of became the big benefit of that. So I don't see it so much as this, aggregation. As a matter of fact, now we can talk a little bit about politics on top of the economy. So we looked at kind of the charts in gold, and we looked at kind of the fundamentals in economics. Now, if you look at the politics of it all, it gets even more dangerous. Right now, the U.S. is kind of a dying empire, if you will. The middle class is being hollowed out. You're seeing less and less high-paying jobs. They're shrinking. Our exports are definitely shrinking as manufacturing jobs have whittled away. So you have Japan, Russia, and China, who they're the next two superpowers, if you will, who are allied up against the U.S., who are trying to marginalize the U.S.'s influence around the world, because the U.S. has always, not always, but for the last 20, 30, 40 years have somewhat dominated the global sphere, if you will. So, politically, this is a really somewhat of a dangerous time. You have Turkey, who has always been a strong U.S. ally, now somewhat talking about that the U.S. was behind this coup. And this is unbelievable. And they're actually talking about potentially allying up with Russia instead of the United States and leaving NATO. Well, Turkey is an incredibly important country because strategically it's right between Europe and the Middle East. And then, so that's Turkey right there. Then you have the Ukraine, and the U.S. has been somewhat belligerent, trying to control the Ukraine when it's right there on the Russian border. Talking about putting missiles defense in Poland. very risky stuff. So we're actually antagonizing against Russia. And then on top of that, you have ISIS, which is a big global mess. And then you have civil wars in both Syria and Iraq. So the political foundation, the political underpinnings of the global economies is incredibly unstable. So it's really difficult. I mean, the G20 meeting, they said the G20 meeting this week in China, and nobody could really kind of get along, if you will. There's a lot of, it's a very destabilized world, both politically and economically. And so it's kind of a good time to buy gold and silver.
Yeah, it's a good time to be in something that's been around for thousands of years, rather than just that fiat paper that they're pushing. Don, talking about that fiat paper, I wanted to ask you about the dollar here and gold. Gold is at $13.50 or so. I haven't, somewhere around there. We saw a big move up today. And the dollar index is actually pretty high. It is down today, but it's close to 95. So, what that's telling me, at least, is that we're having a relatively strong dollar while gold is still going up. So what are your thoughts on this?
Yeah, you're right. It was at 94.8, which is right at 95. The gold actually had a really big move with the dollar staying up. I think one of the reasons why is because the yen actually fell. The yen to gold seems to be somewhat of a stronger correlation than the DXY, and the yen went from about 104 to 102, and I think that kind of gave it some strength. So what you want to look for if you're going to look at some of these indexes, the DXY and gold, the price of gold, is U.S. dollar yen, and the other one is the 30-year U.S. bond. Those right now are correlating fairly strongly to gold. Now, as far as I'm always nervous when gold is over 94, because I feel it creates headwinds for gold, so it makes it tough for gold to break out. I think that the dollar is going to break down in the next 12 months. Some people think that the dollar is going to get stronger. I know Jim Rogers, he's a big one that thinks the dollar is going to get stronger because it's going to be a kind of a hedge. But I see the dollar breaking down myself. I think it's going to get a lot weaker, and I think interest rates are going to go higher instead of lower. A lot of people think the 10 years is going to go negative, but in the next 12 months, my feeling is that interest rates are going to go higher and the dollar is going to get weaker, which is the opposite of what you would think. You would think the dollar would get weaker and interest rates would get weaker. But my gut says that people are going to run from the dollar. And when they run from the dollar, it's going to be a mess. So they're going to have to raise rates. That's just my gut. I could be completely wrong on that. But I'm really nervous about it. I think inflation could really jump up here if the dollar gets weaker. So we could have the worst of all worlds right here. It's hard to say. I mean, it's a big mess. We have a big mess in our hand. Debt has just been exploding. We're up to $20 trillion, and it's just going to go higher and higher and higher. Both Hillary Clinton and Donald Trump have both said that the deficit is not a priority. Trump said that he's going to, rebuild the military. You can't rebuild the military and decrease the deficit. It's not going to happen. And Hillary is going to follow the Obama line, which has been deficit spending. So debt's going to increase. So it's kind of a dangerous situation, if you ask me.
Well, sir, I couldn't agree with you more. This is Don Durrett, everyone, of goldsilverdata.com. Don, is there anything else that you'd like to share with our audience before we say goodbye here?
Just a couple things. I had a couple more notes. So just a couple more things I wanted to mention is oil, I think, is really significant here. So we have about 500 million barrels in inventory where the norm is about 350 million. We'll have 150 million of this excess oil. So, which basically that 150 million is going to put downward pressure on oil for at least 6 months. But if we burned off 1.5 million barrels, it would take a year to get back to somewhat normal range. So I don't see oil breaking out unless there's a war, if you will. We're going to have, and then if OPEC decides they're going to cut, but we have this incredible overhang of inventory, which is going to create a big mess. So I would look, for downward pressure with oil. The other one we haven't talked about, is the BREXIT issue. So BREXIT is creating a lot of instability in Europe, putting a lot of pressure on the euro, and Italy is going to have a referendum, where the Prime Minister, Matteo Renzi, basically said he will resign if it doesn't pass. And so basically what people are saying is that if it doesn't pass, if it fails, and he basically leaves office, that whoever replaces him could potentially have a referendum to leave the Eurozone. And France is actually the other one. So France is actually potentially could leave the euro because of all their immigration problems. So those are two huge issues that I would keep an eye on.
I mean, from geopolitical, from fundamental, what's going on with the economy, global economy. I mean, it all points towards real assets, because you're talking about uncertainty and then something that we can be certain about, and that is gold and silver here.
Right. One final point, I want to talk about the interest rate trap that we're in. So the interest rate trap is that if they and we're already at negative rates. Today I was reading where 2 corporations in Europe are going to issue bonds at negative rates. The negative interest rates, and I think it's like 10% of sovereign debt right now is negative. So we have all these negative rates. Negative rates is not good for the financial system. And you can look at the weakness in the banking sector, especially in Europe. These negative rates are basically squeezing the financial system. So we can't go lower. But simultaneously, we're trapped because we can't raise the rates. If we raise the rates, you're going to create a recession. So we're in a really fine line here. It seems like we're completely trapped. I'm not sure. But that's something to definitely keep an eye on. Like I said, I think interest rates are going to go higher, and when they do, it's just going to be a big, big mess.
That's interesting, and we'll keep an eye on it, and we'll definitely have to do a follow-up on that if we do see interest rates go up. So I guess quick question, do you think interest rates are going up here in September?
No, I don't think it'll happen now. It's going to be something out of left field. Look for it towards the end of this year. But when it happens, it's going to be the U.S. When I talk about interest rates going up, it's going to be in the U.S., not somewhere else.
Right.
And the reason they're going to do it is to protect the dollar. So something's going to happen to the dollar, I think, before the end of the year because of all this debt. So we've been exporting all of this inflation around the world with our dollars, and something's going to break. I just have that feeling. And so before the end of the year, that's a reason to hold physical gold and silver. We didn't talk about mining stocks too much, but also I changed my domain. It was goldsilverdata.com. It's now goldstockdata.com. More of a stock website than a data and data. So, but if you do gold silver data, it'll open it both in the new one up. So even though I have both domains, but the new one is goldstockdata.com.
Well, all right, everyone. Don Durrett of goldstockdata.com. Did I get that right, sir?
You sure did.
Okay.
So
well, I look forward to doing a follow-up interview with you here in the near future and discussing, again, the things that we've been talking about and kind of seeing how things play out.
Sounds good, Ken.